Good morning, everybody. This is Patrick MontesDeOca with the early morning update here for January the 8th, 2021. We have a great deal of volatility this morning. In the gold market, we're trading down about $51 in gold. And we've come down to some extreme levels, below the mean. And we're suggesting our traders here to cover any short strategies and prepare to get net long. I think we've come to the completion of this correction here. So I may be a little bit early here, but we're getting activated from the weekly buy one of 1861. At 702. On the 715, a close above 762, 1862 is going to activate a buy trigger from the weekly buy one level. So let's just watch the market here and pay attention. It's time to trade, and I'll keep you posted. We got we're looking for a confirmation here that we got some reversions unfolding here. So it looks like at 7 we got a buy trigger. From the weekly here coming up. If it closes above this pivot point at 7:15, which is in about 10 minutes, it's going to activate a buy trigger. This 1861 is a strong probability level that we're looking to hold. $18.61 is holding here. Things are quieting down here as the market is slowing down the selling pressure. So we are getting more validation, and we should see some buyers come in here, start to come in here and see these bars turn green. Today is a day that is wiping out a lot of stops, and the sentiment of the market actually is shifting. It's changing now. It's probably at its most pessimistic level here, possibly very bearish, which is an indication here that we're coming to some kind of a bottom here. Now, right underneath the buy one weekly, you're looking at the monthly 1848 level. That is the monthly level that we have pretty much underneath the market, and we begin to see a lot of major support now coming into the market from the monthly to the annual and so on. That gives us an indication that the market might be near the completion of this correction. We are testing the signal here, 1861. And for all intents and purposes, it can activate the monthly 1848. We've activated that monthly signal way back on the monthly, if you recall. $1962.50 was activated monthly. That was the signal that we had coming into this month. And this came into the daily, the weekly. So it gave us a chance really to take advantage of this situation. And now we're looking at the market almost coming down to the extreme below and meeting the target of 64. We've broken the monthly. And so we are in an area that is a critical area. And let's continue to watch the trading that occurs in here at these levels here, particularly around the mean, which is a 50-50 standard deviation. So there's going to be a tug of war now at these levels between the bulls and the bears. Let's see how they resolve this supply and demand here. 59.60 trading here. So this is going to be a level that is going to define the kind of support that we're looking at. Very quiet, very quiet. It's slowing down the selling pressure here as the day progresses. So, and the really incredible relationship that I find always between the price and these levels is incredible, particularly because it defines really where in the trend of the market, whether it's daily, weekly, or monthly, you're going to find those buyers that support that you want to identify if you are a buyer in the market. And so, we're looking pretty much at all the three trends right now between the daily, the weekly, and the monthly now. And we have a pretty good picture in terms of where the supply and demand is being traded. Let's just continue to watch the market here for a little bit here as I do a little bit of trading here, and we are suggesting all of our traders to do the same as far as covering any short positions or strategies that you might have taken here. 53.5, still drifting lower, making a low of 52.50. 1848 is the monthly average. So let's continue to see the trading here at these levels, and just see if we get a close about 1861, which will activate the weekly trigger. We are extremely oversold on the daily, and so the daily has gone neutral, and we are pretty much now, we're getting oversold on the weekly below the B2 level. So the signal is basically waiting to get on the long side of this market on a close above 1861 would activate the weekly buy trigger. This is, I think, the capitulation, the liquidation of a lot of this bullish, or you might say a lot of these weak longs that came into the market in anticipation of this market, following pretty much even the virtual currencies here. The gold market is still being manipulated by the powers to be, and they cannot afford basically to lose this battle in terms of the gold market as a hedge against what inevitably is coming here, which is an implosion on the U.S. dollar. A devaluation on the U.S. dollar is happening as we speak, whenever they again print all the stimulus that's coming into the market. It is pretty clear now that the 1962.50 came in, and it became a triple threat, so to speak, in activating the short trigger, because it coincided with the monthly and the weekly, or exactly at 1962, and the monthly sell one level. It was pretty, I think, clear that the VCPMI identify what we call the distribution of supply. So it's a question of basically how you, as a self-directed individual, handle this kind of intelligence. When it tells you, 1962 is the harmonic level, daily, weekly, and monthly, and if it closes below there, it activates a triple short trigger. How you apply, how you implement that is basically up to you, based on your profile. Looking for a close above 1961 to activate a buy trigger weekly. So this is the intelligence that, let's say, it's given us right now, and the question is, how do you handle that if activated? In the same way that when in 1962 it told you that is an area of distribution of supply, how do you handle that? And that is a question of, again, your profile. It's a question of how you manage the risk. Now, the 1962 was the sell one monthly. It's the sell one, the sell two weekly, and it was the high yesterday made of 1962. On the buy side is 1861. Waiting for a confirmation to activate alongside. And so, for example, if we do get a close above 1861 now, you can, since you covered, let's say, if you were short or you're looking to cover or you're covering your short positions into these levels all the way, let's say, into 1848, then wait for the trigger point to dollar average to activate additional inventory. These are the levels that the VCPMI alerts you as a self-directed trader how to deploy the inventory. And obviously the choice of what inventory is, again, up to you as an individual, trader, your profile. But this is the directional signal in the futures contract that identifies with high probability the reversion levels that occur in the direction of the market based on its momentum that can give you a pretty good picture of how you deploy that, how you deploy your capital, and how you diversify or how you manage the risk in the deployment of your capital using the VCPMI. So it is like, as I said, a GPS. It's not 100%, correct all the time. Nothing is. But dealing with probabilities here as a self-directed trader, for example, if we take a look at where we are right now, we're taking a look at the market coming down pretty close to the monthly average of 1848, which is a 50-50 standard deviation on the monthly basis, on the monthly signal. And it represents the strength of the longer term average price in gold. And so we're looking at the monthly, which is the long term in trading futures. It's a position signal. It's a monthly signal, and it's a very predominant signal in the overall direction of the trends. And basically, I break down the market in trends: day trade, day trend, weekly trends, and monthly trends, annual trends, cyclical trends. So to see where we are, for example, in relation to the bigger trends in the market, we can take a look at the relationship of the price, for example, of the monthly, which is 1864, and the buy one level of 1816, and right underneath is 1810, which is the 360 day average. And here, clearly, the 1816 area is a major area of support. Short-term, intermediate, and long-term. So the 1816 mark is a solid mark. The 1864 is the average price, and if we incorporate the Fibonacci retracements, we've come down to about 38% retracement from the high of 2089 to the recent low of 1767, which I believe is going to be the basis for anticipating the future price. So coming back here, which is what I've been saying here in this market in particular, we are dealing with high levels of volatility, unprecedented volatility that, ordinarily pretty much in the gold market, what it used to represent, let's say if you traded a multiple of 1, now it's, I would 10 to 1 at least on that same multiple. So one contract traded before, it's like trading 10 contracts today. And that's an incredible volatility. So it's great to trade the volatility, but you got to manage and adjust the risk accordingly. Where I'm shifting, so to speak, the risk management is that once I identify here the signals, ideally harmonically, let's say getting above 1861 would be a very strong indication. Getting above 1864 would bring in the monthly bullish trend momentum, supporting that signal, activating the 1950 again, and activating the shorter term targets at that point, which is in the 1881 to 1893 on the weekly. And 1893 is a harmonic level, which is one of the reasons why you see here after the market came down through that level here this morning at about 12 a.m., which is another reason why I woke up at about 1 o'clock. And I can feel the pulse of this market when you get close to this volatility, even in your sleep. It's amazing. And it becomes real part of your being, really. If you love trading as much as I do, it becomes part of you. And it is very clear to me that once the market broke this harmonic relationship, it had difficulty getting above it. And then when it kicked in this signal here at 4 a.m. and it traded, on the short side, it really kind of fell off and tried it again at about 6 a.m., but it couldn't get up there, and then it just collapsed from there. This signal was a fake signal, obviously a weak signal, because even if you did take this signal, 1881 close below would have been a level to get out, or if you're managing it conservatively on a close below, that would have been a level to manage the risk. But again, according to your profile. So according to, again, the way that you are positioning yourselves, or are you building a position here, this level in blue actually is an ideal level to scale into a multiple number of positions. If the signal is activated and you can build a position here, because it identifies basically the highest mathematical probability where you're going to find buyers. So here, once again, going back to what the AI was telling us here, that we are looking to see some buyers here, that we should see as we come down into that 1848 average monthly, we should see buyers show up. And sure enough, the low is 1855.80, and that's where the buyers came in. So that we found buyers higher than the average price of 1848. And now if we get above 1861, we're going to activate another buy trigger. Let's watch the market here from this signal here. We're getting some buyers, and we're activating a trend alert from 1861. $18.61 above is a conservative buy trigger. And actually, the fact that the market came down almost to the monthly level of 1848, we found buyers there, which is really what I was looking for. And now that we are getting a green bar here, then we could be covering some more short positions if you're entering into the long side of the market. We're going to be looking to take some profits here on dust, and the market is holding the 1861 level here. So let's just watch the market here for a little bit. Let the market confirm it for us here. Waiting for a close above 1861. Just continue to watch the market here. 57.80 offered. 57.10 traded here. Once again, this is a time for you to, depending on your profile and how you position yourself, if you're just day trading the market, obviously, we're waiting for a buy signal here at 1861. If you came in on a hedge or short, obviously, the targets have been completed here on the downside. And it's giving you a chance to recalibrate your inventory or reposition, you might say, on the long side of the market. What I've been doing this morning for myself here, actively covering my short risk that I have and getting pretty much on the long side of the market, as I personally feel that the market is, to me, indicating that harmonically here, it looks like we've come down to a high probability level where we're going to start seeing some buyers come into the market. A lot of smart buying coming into the market that essentially is going to take ownership of the price. These are strong hands buying at these levels, as opposed to the speculation that we saw at 1962. And, here again, 1962 is just a few days away. We're trading, with a low of 1849. This is what it's called volatility, and adjust the volatility according to your profile. I do suspect that as the day progresses here, that if we do not see any more selling pressure down here, we're going to start seeing some of this short covering their short positions and precipitate pretty much a self-fulfilling prophecy of buying or demand to come into the market, or demand paper to come into the market. $58.5 30 traded. So we're pretty much consolidating at these levels here. There's not much to be looking to do here. The market in silver as well is extremely oversold. So the metals are extremely oversold. We're getting a little bit of a sell-off taking place here on the E-mini. So the markets are a little bit choppy here. Let's continue to focus on the gold here. 1861 is going to activate a buy trigger. $18.61, a close above $18.61 is a buy trigger. Activating a buy trigger at a close above 1861. It went long at 1861. We're going to 1861 is a buy trigger. We're going to be looking to add to our position here as we get more confirmation on the long side. Trading 59, 90, 60, pretty much trading around that buy one level. And I do want to point out to you that, the low was 47, so we're trading at 60 already. We found some buyers down there. 60-20 traded, 1860-20 traded. The buyers that bought the market here last week obviously got killed, got stopped out. This feels like and looks like a capitulation. So I want to patiently wait for the market to settle a little bit here and get some price stabilization, so to speak, when in executing. So, but in the meantime, it looks like the 1859.60 level is holding. It's a good day to test the integrity or the robust internal fortitude, you might say, of the long side, of the longs. I would like to see another green bar close above 61 in 5 minutes would validate the buying strength that we're supposed to be identifying down here. $59.50 traded, 70 traded, 80 offered. $60.10 traded. So we're getting a little bit of buying coming into the market here. It's a good sign. This is what I wanted to see. I want to see some green bars after this, the end of this bar here. Trading above 61 is going to encourage more buying or more short covering to take place. $18.60, $60.10 offered. So we're trading the $18.60 handle. I wanted to focus again on the gold market here, particularly because the market right now is in the middle of a transition uh, from actually a commodity to what is becoming a safe haven and a risk asset, so to speak, against this stimulus that's uh, being implemented into the market. And according to some of the economic indicators that came out this morning, the economy is still showing it's slowing down here. So the pressure to continue to maintain interest rates at bay uh, still intact, to continue to maintain interest rates low is still intact. And I think we're going to have rates low for quite some time. And there's no other way to maintain this record unsustainable amount of debt that we have, which will be at jeopardy, obviously, if interest rates begin to increase. Just to review here, today's action in the market has been counterintuitive to all of the fundamentals that have been occurring in the market here, even with regards to what happened here in Washington this week, which was counterintuitive. That you would have thought that essentially the gold market would move on that news, and that the stock market will collapse, so to speak, or at least have a correction. But it doesn't appear that's to be the case. So any conventional wisdom no longer applies to these markets. The conventional wisdom of the relationship of Main Street to the stock market, is completely broken. And I think in all reality, the markets are still trying to find and recalibrate, based on this economic collapse that we saw as a consequence of this pandemic. So I think we're trying to adjust to this new reality, not only physically, mentally, psychologically, but also, pretty much in terms of values with regards to anything that's related to the US dollar as the world's reserve currency. So that's what we're talking about in the big picture, is that if the Feds continue to stimulate the economy and continue to print money in unlimited amounts at record levels out of thin air, it really jeopardizes the foundation of the asset base of the U.S. sovereign base, so to speak, that is at jeopardy, that could precipitate a tremendous implosion in assets in US dollar terms. This is not what the Feds want, and I don't think it's good for anybody if that, in fact, occurs. So use this opportunity, my friends, to again take advantage of this incredible market, continue to cover your short positions, and I'm getting on the long side. I don't know about you. In the meantime, thank you for the advantage and the privilege again of being able to share this information with you here. And until next time, my friends, be well. Take care. I'll talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.